Hey everybody, it's Will. I got Miles with me for this week's Nasdaq Dorsey Wright podcast. We have a hodgepodge of stuff that we want to go over. No particular order, but I say we start out with a shout out to Papa Dow going on, 13 days?
13 days. If we knock on wood, if we close today, it'll be 14 for the longest streak ever.
So 14 consecutive days if we close Thursday, July 27th. Positive.
In the green, yes.
In the green.
Yes.
Because we're already at 13.
We're already at 13, so it'd be pretty historic if we got through today.
No kidding. Yeah, I was looking at the Dow chart as I haven't looked at much of this year, to be honest, because you had the Nasdaq and the S&P just looked ridiculous on these huge stems of X's. But I mean, the Dow chart kind of breaking out of that trading range looks half decent. I mean, for 13 up days, it hasn't run to the moon, to be honest. But looks half decent.
Well, what I'll say is it's really nice, and it kind of fits the narrative that we've been going on in terms of increased, upside participation across the board. It's still a laggard year to date, but nonetheless, right, to sit here and say going on the longest streak ever for a laggard in comparison to the S&P 500 and Nasdaq so far this year. Good to see that upside participation for the Dow.
I'm sorry, I have to take a moment. Pineapple Waterloo sparkling water. Not a good choice.
Well, there goes our sponsorship.
If somebody feels strongly, you can tell me, but not a good choice. Anyways, yes, good point. And talking about the catch-up trade where Dow catching up, small caps have been catching up. They've still been outperforming their large cap peers. Something that we've liked to see, broadening participation, et cetera, et cetera. I think Joseph was going to talk about that a little bit today in his fund score piece, seeing that equity core reading for the large cap US market is so high, typically around these points where you see some broadening in score. So that's good. Some other things that I think we can jump off of, just if you look over the past month, so over the past 30 days, performance trends, crude oil up 14%. Broad commodities up 7% or so. A lot of that's come in the past week or two on some supply concerns. Nasdaq Composite up 6%, S&P up 5.5%. Dow's right there up about 5.5% as well. I think banks were up 20% in the past.
Over the last month, right?
Yeah, over the past 30 days, over the past month, banks like KBE, KRE, big banks, regional banks, both up considerably. It's becoming tough to find a down area for the market. It's been a lot of green.
And what I'll say is that's a lot of areas that you just mentioned, banks, commodities, especially a couple I'll kind of focus on that you just said. Those have been some areas which have struggled recently. So some laggards throughout the rest of the year over the last 30 days. Again, we just talked about the Dow for a moment there to start the podcast. We're seeing a lot of these laggards start to pick up across the board. What are your thoughts? Good or bad on that?
Nightmare for momentum continues. I mean, just your best performing areas in 22 have been the worst in 23. And then that's kind of continued. Then when momentum finally caught up to some of the large cap, mega cap growth, you get small caps picking up, then you get maybe value, mean reverting a little bit as well. So yeah, my thoughts are just a nightmare for momentum and trend following.
Yeah, I guess the saving grace on this one, and again, knock on wood, right, is that tech or kind of those large cap names haven't slowed down quite yet, right? At the beginning of the year, when tech really did start to pick up, that's when momentum really struggled, right? Because we wrote a feature on it. But that's when tech was kind of at its lowest allocation, right? And so now at this point, although you've got laggard kind of bounces that we're seeing, at least we're not kind of twisting the knife with underperformance from the leaders.
True. And honestly, earnings overall have been a pretty big catalyst for tech. I mean, we were talking about some, but before we came on, the meta chart looks absurd.
Yeah.
That's, what is that up now? It's up 100% this year.
150. 100, it's not even including today's action. Yeah.
And it's up another 5% today.
Yeah. Can you believe it started the year at around 120, I think it was. And now we're on, what is it now? It's 6 or 7 consecutive buy signals with today's action. Back up at the top of the trading band, though.
I mean, that's Alphabet too was up big after their earnings, and these are big companies to be jumping 5 and 6% a day. Yeah, I mean, Microsoft was down, I know, but that chart still doesn't look half bad to me. It still looks pretty healthy.
Right, and I think Ian put it really well the other day. He said that Microsoft lost the day, not necessarily the war quite yet, because Google mentioned a bunch of good stuff about their kind of cloud I think they mentioned cloud or AI
mhm.
based stuff. I think it was like 80 times in their
Yeah.
earnings call. I saw
Yeah.
some stat. So seems like they're doing pretty well on that front. Also talking about Meta and Google, seemed like ad revenue across the board was pretty strong. It's a little bit more fundamental, but
Mhm.
nonetheless, yeah, I know it's scary. But nonetheless, good to see those stocks participating, leading the tech kind of sector or tech tilted areas
Mhm.
higher
Yeah.
as well.
And looking at these charts too, I mean, this is more of an anecdotal statement, but I think it checks out in terms of investor behavior. Your best opportunities to purchase are typically never when you would feel most comfortable, right?
Right.
So you look at something like Meta last year or Alphabet last year that were just getting crushed, or I don't know if you can say crushed, but not doing well. The charts didn't look good, the fundamentals didn't look good, the outlook didn't look good, and it turns out that was like one of the best times to buy the
Right.
companies. But then on the other side, there's countless times this year where we've talked about, oh, Meta's overbought, Google's overbought, the indices keep going up, whatever. Like you're not comfortable buying there either. You're not comfortable buying when the market's running up, and you're also not comfortable buying when things are completely selling off. Because so either way, there's opportunity to be made. I guess is my point, is like investing shouldn't be super comfortable, and like your best investments, you shouldn't be fully convinced on that you're getting them at the exact right time.
Right, exactly. And that kind of reinforces the old saying is that when you either are sitting there waiting for a pullback and one never comes, possibly the best course of action for some of these technically acceptable names, or really just strong household names that you look at, dollar cost average into them. I mean, I'm
Yeah.
even though Meta and Google's still more actionable, but I mean, Meta in general is pretty overbought at current levels. Don't think it's just a bad opportunity to continue to kind of load in over the next course of the next couple of weeks. See what happens. I mean, it could run up another
Yeah,
150% by
sure.
the whatever it is.
Kind of
But
take what the market gives you.
yeah,
Yeah. Anyways, I mean, we've had some other kind of changes on our platform and on our indicators that we thought it was worth talking about today. We talked about international equities a bit. If you followed our report, we saw, I think this was over the past week, right? Domestic edged out international equities.
yes,
Yeah, so we have this thing called DALI. I'm sure some are probably familiar. It's dynamic asset level investing, and measures 6 asset classes and their relative price strength, which means that we need to see the asset classes that are performing the best to rank the highest. International equities fell to second. Domestic equities moved back to first. And you've been looking at some like emerging, developed type of international stuff for your piece today. Yeah.
yeah. I'll stop you there because you said that internationals fell to second. I would say that domestic equities finally earned the #1 spot. Right, it's because when you look at kind of the signal history, and perhaps we can kind of put that signal history on
Yeah.
the screen for you here. It's not that international equities is rolling over, right? I mean, we've still got that kind of tailwind as the US dollar continues to kind of have a technical breakdown per se. That's good for the equity space in general, more specifically internationals as well. But domestic equities have finally earned or maintained their relative strength long enough to move into the #1 position. But I digress. I was doing some looking at the spread in between developed markets and international markets throughout 2023. Developed markets have really held their own. There's been an area that's kind of flexed its muscles against emerging markets. So I was curious, okay, hey, with recent action since the beginning of July, emerging markets, specifically representative EFA, printed, or excuse me, EEM for emerging markets, printed a second consecutive buy signal, has seen its fund score increase pretty nicely, outperformed both the S&P 500 and EFA, which is the developed markets representative. And one thing that we typically use is a performance spread. So also ran a rolling 6-month performance spread to see, kind of EFA versus EEM performance. And it seems like, as you can probably see from this chart we're throwing on the screen right now, there seems to be a kind of a cap around a 15% outperformance in favor of EFA. So that was a lot of words, but it seems
If you were to
like,
summarize that,
yeah, if I were to summarize it, developed markets might be in store for a bit of underperformance to emerging markets if history has anything to say about it.
based off the performance spreads.
Yes.
Yeah. And those have been pretty good, honestly, over the past couple of years, like 2022, 2023, in fact, for a lot of areas. Those have been decent. There's been some good mean reversion signaled by those spreads. Some too, and you were talking about like the dollar being a nice tailwind for international. It's typically a tailwind for commodities too, but lately that hasn't been as much the case. Like the dollar's been falling and commodities have been generally underperforming or falling. And then last year, commodities were going up and the US dollar was going up. So a bit of an anomaly with the US dollar. I don't know if that's because we're in a bit of a different regime. I don't really know what the full attribution is there, but that's a place that I would expect at some point to return to normal. I don't know if the US dollar goes up and commodities keep going down, or you actually get some commodities picking up and then the US dollar weakening. Commodities have had a good week. Like I said, I don't know if we can see that really stick out yet. Like precious metals, I think, are near some type of ceiling, like gold is near multi-year highs. Crude oil's got a ton of resistance nearby. Agriculture stuff maybe have some more room to run. I know there's some at all-time highs right now, but it seems not very broad right now. I don't know if there's a lot of tailwinds right now for commodities.
Yeah.
Anyways. All right. Well, I don't know how long we've been talking, but probably long enough that do we want to go to our conclusion about a chart that you wanted to share with the people, chart I want to share with the people?
Yes. Yeah, we can we can kind of do that and wrap up there. I told Will before, I was like, oh, what are we gonna do for our kind of chart of the week? And I said, mine's gonna be one that's kind of, as for lack of better words, put the team on its back over kind of the last week or so. And my chart's gonna be Boeing. You might say that I'm looking at, some of the big tech names we talked about previously. I'm talking about Boeing, one of the members of the Dow, which, as we opened up the call with, seen a nice historic run. Boeing, while they still on some recent earnings results, had some really strong cash flows on some deliveries of their planes. Industrials have been a strong group really throughout the course of the last couple of months. Boeing itself, on 3 consecutive buy signals, has run up into slightly overbought territory, but nonetheless, yeah, exactly, like everything else. But nonetheless, right, it's kind of a name that you look towards, and you look at the Dow and you say, hey, this is one of the reasons why. So
yeah, that's a good call. I was looking at the chart too, going back. That is a nice little break out of a trading range that it's been in. Looks like you're even above the January 2022 highs, which I think is pretty notable. Yeah, that's a good find. The one I wanted to throw out to the people was sentiment based, the AAII numbers. So if you want to measure like kind of retail individual investor sentiment, the bull bear spread, so the percentage of respondents that are bullish on the market for the next 6 months, subtracting the percentage that are bearish, that's at like 28% on the chart level, which is high. At your highest level since 21. And if you look back at the chart over the past 5 to 10 years, it typically doesn't get much higher than this. So that would be my kind of concern, is that too many people get on one side of the boat. Everyone can't find a reason to sell. And then we know typically that's some type of intermediate term top for the market. That's not to say that we have to go down substantially, but it does seem like some exhaustion could be coming in terms of euphoria and people coming back into the market and being excited about it. So that would be, if I were to point to one thing that would be a bit concerning, again, is the euphoria. Granted, these surveys, and I wrote a piece about this, these surveys, take them with a grain of salt, because you have a lot of response bias. You have some sampling bias in there. There's always the question of, why would smart money be telling the rest of the market what they're doing? There's also the whole notion of people do and say different things. So people may say they're bullish, but they're not buying.
Right, they act a different way.
They act different ways. So there's a lot of ways that these could be skewed in reality. But in aggregate, I would keep an eye on any gauge that you can get of sentiment from becoming too overstretched. Because for the market to function and for healthy bull markets, you need both parties.
Yeah. I mean, I agree with you. I think that's something certainly to watch. We were talking before we started recording about how bad this week, or I won't say bad, but how important this week was. I mean, we had Fed meeting, we had all these earnings, we had GDP in this morning, we've got Apple next week. Let's not even start talking about that. Yeah. But I mean, this week could have gone a lot worse than it did. Can I say that?
Yeah, I think that's fair. I mean, there is a lot more potential to the downside, given that the market's run already so far this year and has had some high expectations, and it seems like those have been met.
Right, exactly. So watch out, because this week, let's see if I can put this right. This week didn't do much to dissuade that bullish sentiment. Right.
Seems to be the case.
Yeah.
Yeah. I think that's fair. I think that's a good period for
Yeah.
for the conversation. Well, cool. You got anything else? No.
I got nothing. You gonna go see any movies this weekend? Barbie?
Oppenheimer?
Yeah.
No, I say so. We did see Oppenheimer on Monday night. I'm not a movie critic, but I enjoyed it. I thought it was good.
I'm glad.
Casty loved it.
Comcast, parent company at Universal, up 6% today. Got to throw that in there.
Yeah, that was good. You haven't seen it yet, right?
I have not.
That's shocking because you're such a movie guy.
I know. I will be going this weekend, so maybe next week
By
I'll have
yourself?
my own review. Probably.
Well,
Yeah,
share with the pod.
I shall.
What do you think? All right, everybody. We thanks for the time per usual. We'll talk to you next week.
See ya.